Morning. My name is Tom Bayer. I'm a partner with Sikich in Indianapolis. We'll go ahead and get started here. We still have a few attendees that haven't logged in yet, but I'll cover a few housekeeping items and we will jump into the presentation. So today's presentation is the road to the Final Four from Indianapolis. Just kidding, of course. It's we're going to talk about the American Rescue Plan, a bill that was passed just a few days ago and signed by the president. We'll talk about specific provisions of that bill that might apply to your business or your employees. So a couple housekeeping items. You can submit questions through the chat or the question feature in the webinar control panel. We're anticipating a lot of questions. We have quite a large audience today. If we don't get to your question during the presentation, you can submit it in the post-webinar survey and we'll follow up with you after the webinar and try to answer the question as best we can. Presentation slides can be downloaded from the handout section of the webinar control panel as well. We are offering CPE credit today. You do need to complete the polling questions that we launched throughout the webinar and in order to receive CPE credit for attending the presentation. And then we do have a short survey that will launch after the webinar, and you'll need to complete that evaluation for CPE, and we'll get you your certificate within the next couple of weeks. So with that, I want to welcome everyone, and we'll go ahead and jump into the content here. And I have with me my esteemed colleagues, Jim Brandenburg from our Milwaukee office and Glenn Birnbaum from our Peoria office. So welcome, gentlemen. And as we go along here, we'll kind of bounce back and forth depending on the content of the slides. So what we're going to cover today, this is a big bill, a lot of pages, a lot of reading, and so we're trying to target certain areas of the bill that we believe apply to our clients and our other advisors out there. So today we're going to talk about just an overall overview of the legislation. We have a new program, a new acronym, the Restaurant Revitalization Grant, which is a lot. That's a mouthful. And we'll talk a little more about the employee retention credit. There's some updates to that. We'll also cover some of the recent, not just updates that were in this bill, but recent IRS notices and guidance that came out. We do want to cover a little bit about comparing the PPP versus the retention credit versus the revitalization grant, and sort of making a decision as a business owner what fits for you and how to navigate that decision. And there are some recent updates that came from this bill as well. So we'll also talk about the COBRA subsidy, some updates to the Family Leave Act, the FFCRA Leave Act. There was some funding for multi-employer pensions, and then unemployment income. We will cover the economic impact payments, some of the credits that were expanded, and then the tax deadline, and then Jim will give us a little sneak preview of what might be upcoming. So that's kind of the agenda for today, and I'm going to turn it over to Jim Brandenburg to start us off with an overview of the American Rescue Plan.
Good. Thank you, Tom, and good morning, everyone. Again, as Tom mentioned, that this is the plan that was the bill that was just signed into law a week ago today, actually, on March 11th. And this follows two other major pieces of legislation that dealt with the pandemic. Just about a year ago was the CARES Act that many of you may be familiar with, that passed at the end of March of 2020. And then there was a sort of CARES 2 referred to at the end of December this last year that offered some additional relief. So now there's been nearly $5 trillion of relief just within the past 12 months that Congress has offered for businesses, individuals, and affected parties dealing with the pandemic. Just to note that the last two major bills were done in a bipartisan manner when they passed through Congress with it. The latest bill, however, was more partisan with it and was passed under what they call the Special Budget Reconciliation Rule. So that was one of the differences with this American Rescue Plan. Again, this bill does provide some economic stimulus and relief to, again, workers, families, and businesses. And this bill was about $1.9 trillion, but about $600 billion of it was for tax matters. There were other spending items in there, but the tax portion of it was about $600 billion. And again, there's some business and individual provisions, and that's what we're going to focus on today. The first thing, as Tom mentioned, is, again, we've got many are familiar. We had the Paycheck Protection Program loans that came about last year with the CARES, which provided some resources and capital for businesses. We have a new one here to deal with the restaurants. It's the Restaurant Revitalization Grant, or RRG, is the acronym with it. And again, as many are familiar with, that the restaurants really across the country have been hit hard with the pandemic. Many have closed, others have scaled back, and some are still suffering. Some maybe were able to get an access and did a PPP loan, whether it's the first or second draw. But Congress still felt there was another incentive needed for restaurants to get them restarted and revitalized. So they came up with this, again, Restaurant Revitalization Grant. So as you see those initials, you probably are familiar with PPP. Well, another one to maybe watch out for now is this RRG. And I think it's an opportunity, as Tom mentioned, really for any restaurant that is out there. And again, it may be for you. Maybe you work with a restaurant or know others that are in it, or just maybe your local restaurant that you may go to. I think there's opportunities for them. So we're going to spend a little time with that. And again, what we have with this new program here is we just have the statute that was passed last week. We don't have any guidance yet from the SBA dealing with it, which hopefully will be coming soon. So we're just going to go through just some of the overall overview provisions with this RRG. Okay, the first thing to note with this is not a loan, just like the PPP loan. It's actually a grant that is being given to the restaurant with it. It does not need to be repaid again if it's going to be used, or it's used for the operating expenses of the restaurant. We'll talk about those. So again, it differs in format from the PPP loan, but similar in concept. One thing to note, from a tax standpoint there for those with this RRG, is that similar in that this grant they receive is going to be non-taxable, for the restaurant entity. The expenses that they have are deductible, and then this non-tax income that they get in the grant will be added to their basis if you're an S-Corp shareholder or for a partnership for the partner's basis with it. So a similar treatment to that, even though this is a grant and not a loan. First of all, we're going to just look at the definition. Again, the definition they have for this restaurant is really wide-ranging with it, and we've got it right out of the statute here. So it's, again, it's pretty extensive what they have. It's, again, a restaurant, food stand, food truck, food cart, caterer, saloon, inn, tavern, bar, lounge, brew pub, tasting room. Again, quite an extensive list of what would fall within a restaurant here. And again, with the primary purpose of serving food or drink to the patrons with it. It does mention also that includes any restaurant that's in an airport terminal or at a tribally owned business or concern. So this kind of gives the definition of what a restaurant is. Next here, we'll look at what the restaurant does not include. It's not one that's in a state or government owned business, so that would not qualify for this restaurant for this new grant. Also, if the entity has more than 20 locations for its restaurants, that will not qualify with it. Even if whether they have a same or different name, that will not qualify. And then Tom will talk a little bit later on this other item that came about in this recent legislation back in December of 20, this shuttered venue operators grant. You cannot get an RRG grant if you've got one of the shuttered venue operator grants. So he's going to mention that a little bit later too. And then last, you don't get this this restaurant grant if you're a publicly traded company. Okay, moving on here. The to get this again, just as you did with the PPP, you know, you did an application that the SBA came up with the application for the PPP. Well, in that case, you went through a lender, you followed, you applied for the loan, and then it went to the SBA. In this case, this RRG, this grant that you're going to apply for, is going to go directly with the to the SBA on that. Again, there's no guidance yet on this application process. Hopefully, that will come out soon with it. And it doesn't seem to be as involved the process as the PPP loans, but we'll have to see again what they come out with on that. Again, because this is a whole new concept that they came up with in this RRG. The next thing I'm just going to talk about briefly is just determining the amount of the grant. How much can a restaurant apply for? And again, I think this is fairly straightforward. Again, there'll be some guidance maybe on it, but the way they laid it out in the statute is pretty straightforward with it. First, these are for existing restaurants that were around in 2019 and 20, and they're still around here with it. The way they determine the amount of the grant they can request is look at their gross receipts they had in 2019 and compare that and subtract out the gross receipts they had in 2020. Okay, so the reduction in their gross receipts is sort of the amount they can apply for, but then you need to reduce that for any PPP loan that they got, either the first or second draw. And that net amount is what they can apply for. So we've got an example here that kind of just walks through that briefly on our next slide here. We've got Justin. He's got this burger restaurant that had $1 million of gross receipts in 2019. As the pandemic unfolded, he had to cut back operations, close, and scale back, and the receipts in 2020 were at $550,000. So there was a $450,000 reduction in gross receipts in 2020. During that time, he did get a PPP loan of $150,000, which was used and was forgiven. So in this case, Justin would be eligible for this RRG grant of $300,000. Again, the $450,000, which is the decline in revenue, less the PPP loan that Justin got. So $300,000 would be the grant that he'd be entitled to in this case. Next, again, that was for an existing business, again, that had been around. If you're determining the amount of the grant for a restaurant that, let's say, starts up in 2020, okay, and what the Congress wanted to have is a provision for these restaurants to be able to get a grant as well. And what they look at in that case is they look at all the expenses, and we'll cover those in a moment here, that they had in 2020 up through March 10th, the day before the bill was signed, to open and operate their restaurant that they had. And then they look at they take out the gross receipts that they had. So it's really the net loss or the net expenses over receipts that they had during that period, because again, you can't compare back to 2019. So they're just going to look at the net of their expenses over their receipts. And again, that's what they can borrow to. And again, if they did get a PPP loan, we would take that out as well. And then the last one I want to just mention is if there's a restaurant that, let's say, is in the process of opening up, but hasn't yet, and they're applying for the grant, then they just look at all the expenses they had up through March 11th, the day the bill became law. And if they did have any PPP loan, they'd take that out, and that's how much grant they get. So they tried to make it accommodating for any restaurant out there, whether it was been around for a while or was a newer one, to at least be in a position to apply for one of these grants here. Okay, here I know it's kind of small with some of the information on here, but you know, what they're looking at is when you get the grant, either before then or as you get the grant, you know, you need to spend it on operating expenses of the restaurant. And if if you haven't spent the money on these items, then you may have to repay the grant. The covered period, though, for this period, or for the restaurant for this RRG, begins on February 15th of 2020 and ends at the end of this year. So it's 12/31/21. So you have a time frame with which these expenses that you can incur or pay those. And it does mention that even that date could be extended even beyond that end of 2021 here. But here's a list. There's an extensive list of expenses, but it's really almost any operating expense that you could think of with the restaurant that they have with it. So it includes your payroll costs. It includes even parts of your mortgage payment, the principal or interest that you have on it, rent payments, utilities. maintenance costs. And again, the maintenance costs, again, is, we've got it listed here. It could include any construction to accommodate any outdoor seating that a lot of restaurants are having now. But also could be some walls, floors, decks, surfaces, furniture, and fixtures and equipment. Again, quite a few items that you could have with it. Any of your supplies, some of your protective type equipment and cleaning would be included. The food and beverage items. Then it just says any operational expenses or any other administrative expenses that they have. So again, my guess is we'll get more guidance on the listing and how to categorize those. And my guess is there'll probably be some type of form that you'll have to file back with the SBA that will show these expenses that you incurred during this covered period for your grant. And again, if you do not spend all the grant, that you would need to repay it. But my guess is with the time frame and the nature of these expenses, you should be able to fulfill, using up the amount of the grant then and not have to repay any of it. And here's just a few other items on this is RRG, just to be aware of here, just a couple other items. The one thing that's that they indicated here in the statute with it is there's a priority in awarding grants. And once they open the window to start accepting the grants from the SBA, the initial 21 days, there's going to be a priority awarding grants in that case for small businesses that they indicate here that are owned and controlled by women, veterans, and socially economically disadvantaged small businesses that will be defined in guidance from the SBA. And then each of those groups will self-certify that they meet that priority when they submit their application. After that 21 days, then others will be able to apply for the grant. The maximum grant that you can get is $10 million, but it's also limited to $5 million per physical location of the restaurant. And the other thing they did with the funding with it, there's about almost $29 billion that was allocated in this bill for this restaurants in this program. And what they did is they split it into first smaller entities or smaller restaurants. $5 billion of it will be for restaurants that had less than $500,000 of gross receipts in 2019. And then the rest of it, almost $24 billion, is going to go to other entities in what they refer to as an equitable manner for other entities based on their annual gross receipts that they have. So there'll be an allocation that they'll make for the rest of the money for these grants then. And then the last thing on here, many of you may be familiar with the PPP loan, that they had a certification that you needed to make that in this case, the one that's the restaurant that's going through and applying for the grant has to make a good faith certification that the uncertainty of the current economic condition makes this grant request. It's an important part of them being able to apply for the grant to support its ongoing operation. So it's a similar certification that you had with the PPP loan, but that will be part of the grant application that the restaurant will have to certify to. So again, hopefully we'll find the guidance on that soon, and they'll provide a little more details on this RRG and some of the steps, both in the application and then what you have to provide later on. So again, any of you who have restaurants or work with restaurants or may just have your local restaurant, just be aware of this new program, this RRG. And again, I think it's something for any restaurant should take a look at as an opportunity here to continue to get them to grow. So with that, we'll turn it back to
hey, Jim, we got a couple of questions here.
Sure.
One is, and I don't know that we have all the guidance we need. In terms of the RRG, we've got one of our participants, 25% woman-owned and 25% veteran-owned, with the president being a veteran as well. Does that qualify for the priority? Do you have any thoughts on that?
I haven't seen that. What the again, the statute just said is that the small business was owned and controlled, by the different groups they mentioned here, women, veterans, or socially disadvantaged small businesses. So I don't know, is it going to be 50% or more? I don't know. We'll have to see, what the details that they provide with that. Again, that gives them the priority as far as applying for the grants, but we haven't seen any guidance on that yet.
Yeah, and so another question, good questions here. If only 2 to 3 locations owned by the person would seem okay. Other people owning some franchises wouldn't matter. So can you speak to the 20 location limitation and how you think that might work, or are we still, again, waiting on more guidance?
Well, one will need some guidance with it. I think what they're saying is that the entity, is the one who's going to apply for the grant, and if they have, up to 20 locations, they could get the grant with it, but again, could not have more than 20 locations within the entity that's applying for the grant. Then.
Okay, thank you. All right, so and then lastly, can a nonprofit social club that runs weekly spaghetti dinners, and spaghetti is my favorite meal, by the way, so thank you for that. Do they qualify?
They knew that. Good question with it. I mean, again, there was a pretty extensive, a broad definition that they had for what is a restaurant with it. And again, I would think that an entity, if that's the main focus of that group is to have that, but again, within a nonprofit, I'm not sure, what other purposes the nonprofit has, but I would think that might, since it is a restaurant, might fall within. And that's where we need to have some guidance with it, because you may have some businesses that, may have a restaurant, as part of the business, but there are other, parts with it, whether or not that restaurant could, apply for, the grant, even though the overall business has more than just the restaurant within it. So we'll have to see, what type of guidance they provide for that, whether it's a nonprofit or other businesses.
Okay, thank you. All right, so we're going to switch over here to a different topic, but before we do that, we have our first polling question. So Jim, would you take that away?
Yeah, our first polling question here for everyone is, and you can take time to fill it out, is, do you think this new restaurant incentive, the RRG, the Restaurant Revitalization Grant, will save the restaurant industry? And our selection, our options are yes, no, or unsure.
And while we're waiting for responses, Jim, I did miss a question here. I'll throw this one out there too. What does covered supplier cost? Is that all cost of goods sold or some sort of hybrid like PPP?
Good question, Tom. With it, what they do include is, with the PPP, that was expanded, some of the costs that were done in the legislation at the end of December, they included some additional costs that could qualify as non-payroll type costs. Those are factored in for a restaurant too that they can use. And then it does mention, some of your food costs would be included as well. And they mentioned in a similar manner that you had incurred costs even before when you were operating back in 2019. So it would be like a cost of sales that you have, your food costs that you have, as well as other supplies that the restaurant is incurring. Again, I think that list is pretty extensive, that not only what they provided, but then they mentioned other operational expenses and then anything else that the administrator, the SBA, decides to include within there. So I think you're going to find quite a bit of pretty much everything that you're going to have with it, I would think would fall within there. And again, it applies not only to what you spend with the grant, but even going back to February 15th of 2020, when that covered period began.
Okay. One other question while we're on questions here. These are great questions. Is there a definition of primary purpose of business being a restaurant? And I will sort of jump in on that a little bit, in that I think what we're going to find, because the shuttered venue operators grants, somewhat similar, is more than 50% of your activity, of your receipts, is probably going to be one of the main factors you're going to look at. But Jim, do you have any thoughts on that?
I would echo that, Tom. I think that they probably look at their primary purpose being that that it's mostly from the restaurant or the bar that they have there. But again, when you just have the statute to look at, you don't have any guidance at all with it. It's hard to know for sure. But I would think the primary purpose would probably be at least that they would have some indication similar to that shuttered venue operators.
Okay.
Hopefully we'll get that soon, within the next week or two, to provide some more explanation of some of these terms.
Yeah. Okay. Do we have a summary of our polling question results we can share?
Okay, we've got, as far as with the restaurant here, 29% yes, 20% no, and then about half are unsure whether this will save. And I think that's probably a good barometer here. I think some of the restaurants here hopefully will be on the, back improving, but we'll have to see what happens with this. So good. Thank you very much.
Thank you. So we're going to turn our attention to the employee retention credit and some of the recent changes in the Act, and then as well as some guidance that recently came out. And so we're going to switch over to Glenn Birnbaum, who's going to take us through employee retention credit. Glenn?
All right, thanks, Tom, and good morning, everybody. Glad you could join us, and we'll try to shed some light, on this employee retention credit. I guess I've got to try to explain this one. So on slide 18, just a kind of a high-level look at it, what happened with this American Rescue Plan. The ERC did get extended for the third and the fourth quarter. So now the ERC is in play for the entire year, and if you remember, we're talking a $7,000 credit per employee per quarter. That could be up to $28,000, so a pretty big deal. There's also some new rules for startup companies that we're going to talk about. And then we're going to talk about this notice 2021-20 that was not part of the Act, but it was issued March 1st. And it really talks about some of these FAQs and also about how the PPP might interact with the ERC. So moving on then to slide 19, just quickly on the ERC with startups. So if you remember, I don't have this on the slides, but door number one is, right, how do I get the ERC? I have to have a partial suspension. I have to be fully suspended. That's one way to get in. Door number two is I have to have this significant decline in gross receipts. Well, for a startup company, we throw that out the window. All you have to do is basically have revenues under $1 million and start up after February 15th of 2020. So you don't have to worry about door number one or door number two if you're a startup business. Do keep in mind you have to worry about the affiliation rules. So if you have already existing businesses and then you start up another business, you got to look at everything in total. So you may not get that startup rule. And there is also, lastly, a $50,000 credit per quarter for the startup businesses. Okay. All right, so we'll talk then about this notice 2021-20. And this came out again March 1st. It's important to note this is just for the 2020 ERC. It is not talking about the new changes that happened in 2021, so it has nothing to do with the bill that was passed December 27th, I believe. So it has 71 questions and answers. And a lot of this is kind of just formalizing the FAQs that were already published, on the IRS website. So, an FAQ is not authoritative. This notice, though, is different. It's a little higher up on the food chain, as I would say. So just keep that in mind. We've now got a more formalization to this process. And there's kind of 4 takeaways that I'm going to just quickly go through is, what's the meaning of nominal? What do we mean by comparable? How do we maybe interact with PPP? And then just a reminder about how this works for income tax purposes. Okay, so we're going to move now to slide 21, okay? And you might remember this in some of our past webinars. We were like, what's the definition of nominal? What's the percentage? Well, they come out and say it's 10%, okay? We had speculated somewhere between 5 and 10%. So this gets a little weird, but more than nominal means 10% or more. Okay, so it has to be more than nominal, but the starting point is 10%. Okay, so it's not more than 10%, it's 10% or more. And so when does this come into play? It's primarily if you're talking about maybe an essential business where that business was not shut down, but you have maybe a portion of your business, a division, a subsidiary that was impacted, that was shut down. And this can be very good if 11% of your business is impacted. It would actually taint the entire business. And you could be considered partially suspended, and you could get in on door number one. Another example where this could come into play is if your indoor dining was shut down still for a restaurant. So presumably if indoor dining is more than 10% of your revenues, or they talk about more than 10% of your service hours, or actually it's equal to 10% or more of your service hours, then you would be considered, this portion of your business is more than nominal. So we have now a very quantitative test on what nominal is. It's 10% or more. Question 16, if you remember, there was some FAQs that talked about like a software company where every employee was working from home at least 1 day a week pre-COVID, and then after COVID, they were all working from home 5 days a week. And is this comparable or not? The IRS said, yes, it's comparable, so you're not going to be in on door number one. Well, they provide just a little more context about how you might evaluate this. Some of these factors, we don't have time to get into them, but they're kind of listed there as far as, how portable is the employee's work and that type of thing. Okay, so slide 22. Slide 22, I've changed about 3 times since these slides have been posted. So what's in your handout is you're going to need to make a modification under question 18. Again, what's on the slide is right, but in your handout, I have a typo in there. So you would delete the 4th bullet point if you're looking at your handouts. So question 17 is talking about, okay, my business is open like a restaurant, but the operations are still subject to modification, right? I still have restrictions on my indoor dining. So I'm fully open, but I have restrictions on my indoor dining. And if you remember in that FAQ 34, the IRS says you're still considered partially suspended, even though your restaurant is fully open, because you have this, 6-foot concept between the tables and that. So they talk about some other scenarios, our services, do they have to be performed on an appointment only basis, so there's no more walk-ins, or do I have to change the format of a service? And the example they give is, I no longer can have a buffet, so that type of thing. So they get into kind of some more qualitative factors, but then they also put what I have underlined in here, which is probably the most confusing part, because they don't really explain how to compute this, but they say, if this government order, this modification results in a reduction of the employer's ability to provide goods or services in the normal course of business of not less than 10%, that will be deemed to have a more than nominal effect. So we still have the 10% threshold. It's just not clear how you would actually compute this in this modification setting. So it's a little bit frustrating. Tony Nitty, who I know some of you or many of you probably know, who writes in Forbes, I think was the first one to kind of bring this up, that it is 10%, but they don't give a clear example of how to compute it in this modification setting. The one thing they do give a clear example on, or a clear guidance on, is things like just requiring customers to wear masks, having one-way aisles in your stores, that type of thing. That's not going to be enough to be considered, modifying your operations. So again, we get some answers, but we still have some more questions on these points. Okay, so last slide I have, the last concept I have is really this ERC versus the PPP. And just real quick on this, probably the best thing to do is just go through a quick example. So if I got a $200,000 PPP loan, but I had $300,000 of wages, and I put all those wages on the PPP application, right? And I received forgiveness, and now I realize, oh, hey, I can actually go back and maybe claim the ERC. Can I use those extra $100,000 of wages and say, well, I didn't really need them. Can I use those for ERC? And the answer is yes, you can use them. That was the ASCPA actually recommended this. The second point, though, is one that's a little more surprising. So this would be same facts, $200,000 PPP loan, $300,000 of wages. I put all that on the form, but I had, let's say, $50,000 of rent, but I didn't bother to put it on there because I didn't need to, right? And so the question is, now I have $100,000 of wages I can use, but can I now say I have $150,000 of wages? Because I could have put rent on there. And the IRS says, no, too bad, you're out of luck on this. And this went against the ASCPA's recommendation. So this was a bit surprising that, you're kind of tough luck if you didn't put rent or utilities on there. Now, maybe it doesn't matter. Maybe you still have plenty of wages, to claim the ERC, because if you remember, right, you can only, it's only $10,000 of wages for the whole year. So it may not be totally dead, but you just have to calculate it and see. The last thing then is just a quick reminder that the ERC, it is going to be considered taxable income. So unlike the PPP, that's tax-free, this ERC is taxable, and they kind of clarify in this notice that how do you kind of mechanically do this? You really reduce your otherwise deductible wages by the amount of the ERC credit. So bottom line though is it's taxable. So you got to consider that when you're evaluating these options. So that's pretty much it on the ERC. Haven't been looking at any questions that have come in, Tom?
Yeah, I was looking here and I keep going back to that spaghetti dinner. It's kind of got me distracted. Sorry. One question here I'll throw out. Do you think if there is an asset purchase that was more than 50% of the assets, that they will follow previous rules from the PPP, that the continuing entity can use historical data from prior ownership for the 2019 versus 2020 comparison, rather than claim new business in 2020? You want to comment on that at all, Glenn, or maybe we take that?
I'm not sure that I've seen guidance on that. It's probably though because I've forgotten. Yeah, we can definitely, I'll make a note of that one and follow up on that one afterwards.
Okay, thank you.
I do know that the ERC, some of these continuity tests, right? The ERC is a payroll tax credit, right? It's not an income tax credit. So like you get into, Section 382, built-in loss limitations and things, this is a different set of rules. It's kind of the change of control rules I don't think are in play because it's a payroll tax credit. But again, I'll follow up on this and get back to the questioner.
All right, so what we want to do is just do a brief comparison of the PPP versus RRG versus ERC. So quickly, there were some small changes to PPP, another $7.25 billion of new dollars injected under this new act. And they did expand the new category eligible for PPP to include what they define as additional covered nonprofit entities. And these are entities under 501c that aren't 3, 4, 6, or 19, which are basically those entities were already covered in PPP. So really what we're getting into here are 501c5s, 7s, and 8s. So the labor organizations would be a C5, social and recreational clubs, or C7, and then C8 refers to fraternal benefit societies. So those are sort of, I think, under that definition of additional covered nonprofit entities. They also expanded eligibility for internet-only news and periodical publishers, NAICS code 519130. You can see the no more than 500 employees or refer back to the SBA size standard per location. They have to be internet-only news or a periodic publisher engaged in local, regional, or national news. And generally, kind of an unusual certification here, or very specific. The loan has to be used for local or regional news, right? So, and they also said that if you get a shuttered venue grant, you can also get PPP funds. You just can't, you just have to reduce that shuttered venue grant for the PPP money you received. Okay, so that's kind of giving you an up-to-date of PPP. For RRG eligible entities, let's talk about just briefly comparison of the programs. So of course, RRG is specific to that list of entities that meets the definition of a restaurant, right? Which we need more information on to really get into maybe some of the unique situations of whether or not they qualify. But principal business activity of a restaurant. So the first question is for your RRG grant application. I think you got to think about what are you going to use the money for, right? What qualifying eligible expenses are you going to use those dollars for, right? And then you've got to look at ERC, your employee retention credit potential. How many quarters in 2021 do you believe that the restaurant will be eligible for the employee retention credit, right? And that's as we know, that's a revenue test or a full or partial suspension test, right? So you've got to do some homework there to say how much employee retention credit, and then what's our estimate based on eligible expenses, right? Which is wages and health insurance. What's the estimate per employee of our credit, right? For each quarter we think we're going to be eligible. And then we got to think about PPP, right? PPP, we got to think about the uncertainty, the economic uncertainty certification, you know, to make sure we meet that. But obviously for PPP in 2021, we have a revenue decline, quarterly revenue decline test to go through, more than 25%, right? In any quarter in 2020 versus 2019, you're eligible for draw 2 if you meet that and all the other requirements. For restaurants specifically, it's 3.5 months of eligible payroll costs, right, versus 2.5 months for all other. So you get 3.5 months of eligible payroll costs. So what's the potential there? What's that number? And then what's the estimate per employee of the PPP loan amount? And then, you know, how much PPP will be used toward payroll costs, right? Because we have other expenses. It was expanded to include some of the COVID-related PPE and other COVID-related expenses, in addition to these non-payroll costs that were already PPP eligible, like utilities and rent and so forth. So, and lastly, you know, remember this is a federal grant, right? And so federal grants, although we're waiting for guidance, typically over $750,000 require what's called a single audit. So there are compliance costs, probably additional compliance costs for a federal grant that you need to anticipate. So the kind of the question here you have to ask, if you qualify for RRG based on your business activity, is what eligible, could we budget significant dollars to RRG eligible expenses such as upgrades and improvements and other strategic investments that are qualified, right? And we need more definition on some of those things, and then still get some PPP dollars or ERC dollars or both that, again, you know, we can use for payroll costs, right? So go through Justin's Burger Bar, which is downtown Indianapolis, by the way, and it's shrouded in orange and blue for some reason. I think Justin's a big Illinois fan, so we're proud of Justin, and we're going to solicit his business a lot. So let's use that example and talk about his RRG grant from a previous slide, $300,000, right? And he's going to use it for qualifying expenses, right? And in this list, none of those are payroll costs, right? They're all, we're assuming, eligible expenses, right? We need more guidance. And then Justin also gets a PPP loan, per Jim's example, of $150,000. And of that, he uses 90 of it for wages and benefits, right, that qualify as payroll costs. And then he projects revenue declines of more than 20% for all 4 quarters in 2021. He has 10 employees, and so he could also qualify for the employee retention credit. Now remember, the employee retention credit, you can't use the same wages that you claimed for PPP, right, forgiveness. So let's assume that instead of 10,000 of wages per quarter, that he can only claim 9,000 because he's got to coordinate his credit with the PPP wages that he claimed. So so he gets 70% of 9,000 per employee, 25,200 per employee credit. He does have to, you know, pay tax on that credit, right? It reduces his wage expense. So the net credit after tax is $15,100 per employee. So he gets another $151,000, right? So Jim's example, he got $450,000 of RRG and PPP. He gets another $151,000. You know, that's 60% of his 2019 gross revenue, right? So that's quite an infusion for Justin in his business if, if those numbers work out. So I think the key here is to look at what your budget looks like going forward and determine, which ones of these programs, multiple programs you could use to help revitalize, if you will, your business, right, for RRG. So, obviously RRG is for that specific industry of restaurants, but let's look at ERC versus PPP, right? So as Glenn mentioned, ERC maximum benefit is up to $28,000 per year for 2021, right? So it's a taxable benefit, as we've already alluded to. We don't know each quarter in 2021 whether or not our business is going to qualify, right? We have to look at each quarter and perform the test versus the comparable quarter in 2019. And of course, those are future quarters. Are we a small employer, which now is defined as 500 or less, right? That's an important fact pattern. And then ERC qualification is based on, are we going to be based on revenue or full or partial suspension rules? So, ERC, there's some uncertainty as to whether or not we could actually capture that entire $28,000 of credit for the year, because we're looking forward. That doesn't change the fact that we've got a PPP loan opportunity, draw one or draw two, depending on your situation. And, you've got payroll costs are obviously a major part of what's forgiven when you submit that forgiveness application. The ERC and PPP definition of eligible expenses are different, a little different, right? Payroll costs are defined a little, there's some additional payroll costs that you can, benefit costs that you can include in your PPP loan forgiveness. So there's a lot of moving parts here. And then of course, draw two, if you've got a lower employee count threshold of 300. So employers between 301 and 500 really only have the ERC to look at, right? Because of for draw two, because of the different employee threshold. And then you've got to look at, certifications. Can you meet those under PPP? And PPP is non-taxable. So you always got to look at the taxability, the tax burden that ERC creates, because you do reduce your wage expense. And the last thing I'd like to cover quickly is, the shuttered venue operations grant for those that qualify, and there could be some restaurants that, for example, a dinner theater. The question is, which do you qualify for, the RRG or the shuttered venue operations grant? And again, federal grant, potential compliance costs, and this comes out. The application's expected to come out in early April. So, but you also have to coordinate, PPP with the shuttered venue operations grant too. So more to come on that. There is some information out there on this, the SBA's put out. So I just bring this up as another stimulus opportunity that we have out there. Okay, I think we have another poll question.
Yeah, our next polling question here. Straightforward. Have you taken out a PPP loan? Yes, no, plan to, or undecided, or not applicable. So if you could respond that here, and we're gonna get moving on here to get some throughout our topics, with it here. So we're we've got to watch our time here as we move ahead. We've got some other topics to cover here, but if you could just go through that poll now, please, and answer that.
So Jim, why don't you go ahead and cover the COBRA subsidy, and we'll come back to the results of the polling question, since we're sort of running close on time here.
Sure. Okay, just go through this briefly here again. There was one change in this bill here that offered a COBRA subsidy. A COBRA, many of you are familiar with, again, provides health insurance for those who have left their employment for 18 months. What this American Rescue Plan did is provide a provision that an employee can obtain COBRA coverage at no cost for up to 6 months. Okay, so it's going to be 100% covered with it, but it has to apply to what they call an assistance eligible individual. And we'll talk about that in a moment. And again, this is for companies that offer major medical coverage, whether it's a fully insured or self-funded plan. And again, it runs from April of this year through September, again, for these AEI, assistance eligible individuals. How much go to the next slide here. And this applicable individual is one that's lost their health insurance as a result of an involuntary termination of their employment or a member of their family. Okay, so if their job is eliminated or at a layoff with it, they can qualify for this. It does not apply though if there's a gross misconduct by the employee or if there's a voluntary termination. So just be aware of that. And then there's also what they would call a special enrollment period for an employee that did not enroll in COBRA or signed up for it and dropped it. They have a chance of 60 days to roll back in for this COBRA subsidy. Now, employers just need to be aware of this. They've got some notifications to do. They need to notify by May 31st all these affected individuals that would be eligible for the subsidy if they were on COBRA before April 1st, or anybody who is terminated involuntarily now as they go through their COBRA information, make sure that they're aware of the subsidy. And again, there is a credit with this subsidy that if you're a self-insured plan, you get a credit to the extent you're providing this coverage. You can get a credit for a fully insured plan. That credit's going to go to the insurance company, and perhaps maybe they'll pass that back along to the employer maybe. Again, any individuals who receive this subsidy, it's non-tax subsidy for them. So again, just something to be aware of. Really, any company has this COBRA subsidy.
Okay, thanks, Jim. Quickly, we have one slide on there is an extension of FFCRA, which is either family leave or sick leave, and that's extended to the end of the year. It's kind of a new allotment of 10 working days of paid leave. The caps have not changed, so $511 a day for the sick leave and $200 a day, and then they did increase the aggregate cap per employee for the family medical leave through the end of this year to $12,000 from $10,000. So take a look at that. That's another small change, a significant change for those affected, but another change in the recent act. So we also wanted to point out real quickly multi-employer plans for those that are union shops. There is some funding out there to help those plans and sort of delay or defer funding status designation. So there'll be more to come on that, but $86 billion estimated to go into those plans to help the funding shortfalls. Okay. So let's talk about, Jim, the unemployment income, kind of a big change for 2020.
All right, I think I'll take that one, Tom. Yeah, just real quick. No worries. So this is one of the big reasons why we have the tax deadline thing, but basically we have a retroactive change to unemployment income. And so the first $10,200 per person is going to be now exempt from income tax as long as your AGI is under $150,000. So, but an example here, you know, if I have 140,000 of wages and $10,000 of unemployment, I'm at that 150, so all 10,000 would be taxable. So this is a cliff. So what do you do if you've already filed your return? Many people have. The IRS is saying do not amend anything quite yet. We're not sure if that means they're going to try to send the money back some other way, but do not file an amended return. And then if you have not filed yet, what are you supposed to do? The IRS just came out with some guidance on Tuesday. There's a new worksheet that we have on our next slide, but the bottom line is that there's going to be a negative number that you put on line 8 that's going to offset the positive number that's on line 7 of this Schedule 1. But again, software programs are being updated, so at this point, it's just patience is what we need here. because, you know, this bill just got passed last week. And yeah, that's just a snippet of the worksheet, and I'm sure all the software programs will follow that mechanics once they get it updated. We do believe that it's $150,000 per filer. So, you know, if you go married filing separate, that would help. In other words, you don't cut it in half if you go married filing separate. Obviously, you have to evaluate your total tax bill if you would do that. And so again, when it's a cliff like this, you know, can you do an IRA? Can you do an HSA or something to get your AGI under 150,000? So certainly could be some planning opportunities there. So I think that's enough on unemployment as we're kind of running close on time.
Yeah, so we have another poll question here. Jim, you want to give that to us?
Our next polling question here, do you anticipate claiming the employee retention credit for 2020 or 2021? So yes, no, or unsure are our selection choices here. Thank you.
All right, thank you. We'll kind of keep going here, and we'll get to those answers at the end of the program, the poll question answers. So I think, Jim, you're going to talk a little bit about economic impact payments.
Yes. Okay, our next slide here again, just economic impact payments, EIP, or the rebates that a lot of folks refer to them as. For individuals, again, that was part of the stimulus that they had both in the first CARES legislation last March and December. This is the latest round. This is $1,400 per family member, and that's per taxpayer. So it's $2,800 for a married couple, $1,400 per dependent child. And it could even include, let's say, an adult dependent that you had. It could also include for that. There is a phase out with these credits as there was with the other two. It's a little different phase out though. It's for married filing generally it's between 150 and 160,000 of AGI, which again is much narrower than the earlier two rebates. And for single, it's $75,000 to $80,000. Again, what they're going to look at for these rebates is based off your 2020 tax return if you filed that. If not, they're going to look to 2019. And then again, what they're going to look at is, again, when you file your 2021 tax return, if your income is, let's say, lower and you're entitled to this credit, but maybe 2020 or 19 was too high, you can still get the credit when you file your 2021 return. So just something to be aware of with it, to look at it. Again, if you get a rebate and then your income changes, you don't have to repay any amount. And I did list there, they do have some information in the IRS website now that you can take a look at these recovery rebates. So I'm sure there'll be more guidance the IRS has issued. I've heard they've already issued about 80 or 90 million of these rebates just within the last week here already. So most of them are direct deposits. Some will be checks that be mailed out.
Okay. All right. Couple things. Child dependent care credit changes. The big thing is for 2021 only, the child dependent care credit goes up to $3,000 per child from $2,000, and it's now you get another year. So if you're 17 or younger, you qualify. And the phase outs are basically the same. The other interesting thing is that there will be some advance payments made for those that have children under 6 in the second half of this year. So we'll see how that plays out. And then the dependent care credit also increased for dependent care expenses. If you have 2 or more dependents, it went from $6,000 to $16,000, and of course the credit is, and it actually, I'm sorry, the credit increased to 50%. So the 50% of the first $16,000 if you have 2 or more dependents, and it's half of that if you have 1 dependent. So they're trying to, you know, give some more credits for dependent care and get folks back to work. So, Jim, you want to finish us off here to talk about some of the things upcoming?
Yeah, the House just voted here. They're going to look to extend the PPP for another 2 months. It was supposed to expire at the end of March. They're going to go through May 31st. They're looking also to make some changes for Schedule C to include with that. And then some of the banks it looks like they're going to be shutting down on the program early here with the PPP. So just be aware of that. And some of you who may have gone through this second draw process know that they have taken a little longer with that application process. There are some background checks and fraud checks that they're implementing the SBA put those in. So it is taking a little bit longer to go through some of the application process. So something to be aware of if you're going through a second draw loan here. And then our tax deadline, as you see, again, the IRS is behind with some of their processing of this year's returns compared to last year. And then next slide here, Tom, that they just announced yesterday that the tax return due date for individual returns is going to be moved 1 month back to May 17th. The 15th is actually a Saturday, so it's going to go to May 17th. So any 2020 returns you had a balance due that will be due May 17th. However, what the IRS indicated yesterday, last night, when they came out with his notice, is that your first quarter 2021 estimate is still due April 15th. And then the only extended individual returns, so if you're a C corporation, those returns are still due April 15th. And I think trust returns also would be due then. So as they did last year when they made some of these extensions, they provided some further updates and changes with it. So something to keep in mind from the IRS over the next several days or weeks with it. And now all the states need to do is to see what they're going to do as far as following suit with some of these changes here. And then our last slide with it is, again, as Tom mentioned and Glenn, that there's some guidance we're needing from the IRS or the SBA or other government officials and agencies related to this recent bill, the American Rescue Plan. There's still some guidance from the bill that was passed in December that's needed. So we're going to watch for some of that guidance, again, on the PPP loans, the retention credit, the shuttered venue operators, the restaurant program we talked about. Watch for guidance on that. And Congress and the administration are already, pivoting and looking forward toward their next main topic, and that's the major infrastructure bill legislation. Indications are this could be in the $2 trillion range also. And this one, they have already sort of floated ideas and hinted that there'll be some tax increases as part of this package for businesses and individuals. So something to keep an eye on here over the next several weeks or months as this infrastructure legislation is rolled out. So with that, something to keep an eye on with, and again, we'll keep you posted on that and provide other updates, articles, or webinars as those other legislation comes out. So, Tom?
Okay, thank you, Jim, and thank you all for your patience. We ran a couple minutes over. We appreciate all the attendees, and if you do have questions, as we said earlier, please put those on the survey. And one of our survey questions, which we may recognize after the tournament is over, is who do you think is going to win the NCAA tournament? I thought it was kind of a frivolous question, given that it's pretty obvious that got the inside track on that. But please answer the survey. And lastly, do we have those poll question results? I'd be curious if anybody wants to know what those are. Do we have those, or is it too late to give those out?
Okay, who's taken a PPP loan? We've got 64% have taken a PPP loan, so that's interesting. 12% no, and a couple that are looking to 1% plan to, so that's good to have there. So thank you.
Okay, all right. All right, thank you very much, and that concludes the webinar.
Thank you. Bye-bye.
Thanks, everybody. Have a good day.
Have a good day.